Thank you very much. And thank you to Jillian, the entire team over at MASPA, and especially the Financial Wellness Committee for helping us put this together. I know we've got a number of Financial Wellness Education Committee members here on today's call. This is actually our last webinar for the year, so we thank you for joining us. And for those who don't know me, my name is Patrick Ziegler with Earnest Student Loans. I've been on this Financial Wellness Education Committee since pre-COVID and so many years back. I can't remember the exact year, but it's been a phenomenal experience and have the chance to work with a lot of really, really great people, but also share a lot of wonderful and important information with financial aid advisors and others across the Commonwealth. So welcome to today's final webinar. And just to give you a little background here, I started thinking a little while back after reading a few retirement reports about how the real crisis that we're facing may not be the student loans themselves, but it may be student loan adjacent. In other words, it may not be that there's a crisis in repaying student loan debt, although that may change here in the months and years ahead with some of the data we're now seeing. But there is certainly a crisis coming among Gen Xers when you start looking at retirement savings. And so I started talking to my old friend Jack Wang here, who's a financial advisor in Massachusetts, and my good friend Suzanne Hanlon, who works for RISLA in the employee benefit space. And we really started talking about how what might be helpful for not only financial aid advisors, but for our graduating seniors or graduating graduate and professional students, depending on the campus that you're on, might be helpful to really talk about how you want to try and balance student loan repayment with the fact that you should really start thinking about financial preparedness and retirement preparedness as an early career employee. Just a couple of really pretty scary statistics to share with you. And these are both, by the way, from the summer of 2024. And if you want links to any of this information, feel free to shoot me a note and I'll share the source material with you. But the average or typical, I should say, Gen X household right now has about $40,000 in retirement savings. And Gen X are people that are generally in the mid to upper 50s range. Maybe it goes down to, say, my wife's age, which I think is 48 now, but right around 50 to maybe around 60, early 60s, in that range. Now, those are the years, of course, where you're really starting to look at retirement. You're staring right down the barrel of that gun. Many people would like to retire by 62 or 65. It's not going to be feasible if you have $40,000 in retirement savings as a Gen Xer. To fine tune that a little bit more, one study found that by 55, the median, not the average, because the average is offset by some of those 401k millionaires, the median savings for a Gen X employee is $47,950. Now, if you're approaching 60 years old and your goal is to retire at 65, you got a whole lot of work to do if you've got less than $50,000 in retirement savings. Now, you want to couple that with the fact that many people have lost pensions. Pensions are really few and far between right now. So people are not in defined benefit, but in defined contribution plans, which are much more complex and, of course, are really reliant on market performance. Many people now have high deductible healthcare plans. Well, if you have a high deductible healthcare plan, you know what else you have? You have a high out-of-pocket maximum. So we did see a spike, of course, in bankruptcies due to healthcare or health bills that people couldn't pay in the Great Recession. So we know that that's an issue. And then let's bring it back to our topic today, which is the fact that the fastest growing demographic of education debt holders are actually older Americans who are starting to retire, still carrying either their own graduate loans or parent loans that they took out on behalf of their children. So maybe what we're really facing is a student loan adjacent crisis, which is people not being able to retire or not being prepared to retire. And part of the reason for that are student loans. So Jack, Suzanne and I got together and said, let's talk about the things that we can do, not only ourselves, as many of us probably are Gen Xers, but the things we can start talking to our college students about, particularly upon graduation, about how they can manage that student loan debt, ways they can help repay that student loan debt, some of the programs that are out there to help them, while they also start thinking about retirement. Because if you don't, you could end up as one of these statistics where you are within 5 to 7 years of retirement and you have $40,000 to $48,000 in retirement savings. And that's just not going to cut it for most people, especially carrying student loan debt. So thank you so much for joining. We're going to start with Jack Wang today. Jack is a very close and old friend of mine, a financial advisor who works with families throughout the United States to answer two main questions about paying for college. The first is how to maximize aid, even if you're considered too rich. And the second is how to pay for college efficiently without wrecking your finances. So he's really a perfect advisor to have on today's call. He has been quoted or seen in outlets such as Forbes, the Wall Street Journal, U.S. News and World Report, CBS News, CNN, Yahoo Finance, Business Insider, Investopedia, and many others. He's the host of the Smart College Buyer podcast, a regular guest on other financial podcasts as well. And he has written articles for or spoken to organizations such as the New England chapter of the Financial Planning Association, Boston Bar Association, the Massachusetts Society of Enrolled Agents, and we can now add MASFA to that list. So, Jack, thank you so much for joining us, sir. Any questions, feel free to throw them in the chat. We'll try to leave some time at the end as well. Jack, the floor is yours.
Awesome. Thank you so much, Patrick. Thanks to everyone for being here today. And thank you for that. And by the way, so I'm actually speaking to the New England chapter of Financial Planning Association at the end of next month. And what we're actually going to be talking about is how to help clients save and pay for college. So spreading the word to financial advisors, financial planners everywhere to help families avoid taking on a lot of student debt. So today I'm going to keep it really high level. I don't want to get buried in the weeds, but I do want to introduce some ideas to you. In fact, one that probably runs counter to what you hear out in the media and probably even counter to some of the advice that you've received or that you've given to friends, neighbors, or your own students. Right. And again, I love questions, so please participate and let's see here. Let's get going. I'm going to share my screen and then let's go here. Okay, so I just need a quick thumbs up or something from someone just to make sure that I can hear. Okay, see, thank you so much. Okay, again, thank you so much for being here. So, Patrick did a great job of outlining some of the high level issues, right? So it's no secret. Uh, Actually, before we get into that, first, again, this is for compliance purposes. This is for educational and entertainment purposes only. As always, consult your own financial and or tax advisor and like any good disclaimer says, batteries are not included and your mileage may vary. So with that out of the way, again, let me get back to Patrick did a great job of outlining some of the top level issues. So it's no secret. And so one of the sources that we look at is actually the New York Federal Reserve Bank, their quarterly report on household debt. This is from Q4 last year. And the red slice at the top is student loan debt. And you can see with the text on the right, that student loan debt is carried by Americans of all different age ranges. Now, of course, as you get a little bit older, the lower the amount, but it still does exist, right? So this is not a surprise. But if you combine the student loan debt burden plus what the Federal Reserve SHED report, and I love this report. It's actually the Survey of Household Economic Decisions. If you combine sort of the student loan debt and what this report says, it's no surprise that households are strained. Now, we all know about egg prices and everything else, but this report, this SHED report, was highlighted a couple years ago because of this statistic. Right, 37% of all American families cannot cover a extraordinary or one-time $400 expense with cash or using a credit card that's already paid off, right? They would have to borrow from someone or take on more debt or whatever. And so we kind of combine some of these facts, right? There's no doubt that you end up getting reports like this. So this is out of Kiplinger magazine. And you can see at the bottom, American retirement readiness gets a bad grade in one area. And the one area really it's kind of funny. They talk about one area, but they really highlighted three. But the last two bullet points really go hand in hand, right? So obviously, if you spend a lot of money, then your savings don't last as long. Or if you don't have as much savings, you can't spend as much, right? So the last two bullet points really go together, which is what Patrick was really talking about. Americans in general don't have a lot of savings. So what I'd like to do is kind of propose an idea. Like I said, it may run counter to what you're normally used to. Okay. And so if you think about all the media, right? Like the articles, the YouTube videos, the TikTok influencers, or people like Dave Ramsey or Susie Orman or folks like that, generally when it comes to debt, they talk about, hey, try to pay that off faster, right? Like, and so it's not uncommon for people to pay extra principal on their student loans or on their car loan or on their mortgage. It's pretty common. And then again, in the student loan world, we talk about income-driven repayment plans and extended repayment plan stuff, but it's again not uncommon for the typical advice to be pay extra on your debt so you can get out of debt faster. But one of the questions that I get a lot from graduates, this is especially those who have graduated graduate school, like law school and medical school, stuff like that, is, hey, if I have an extra couple $100 a month or whatever, should I pay off the debt or should I save it? What's the better deal? And I'm going to tell you that the numbers are very clear, but this is as much a quantitative issue as it is a qualitative issue. I will tell you that oftentimes this advice and the people who take this advice are driven as much by emotion and their heart and their philosophies and values as much as what their brain says. So I want to just share this idea with you. So let's take a hypothetical example, right? And let's just say, for example, that you have $100,000 in student loan debt, and this could be a mortgage also, right? This is just $100,000 in debt. Take your pick, and it's a 9% interest rate. Again, I tried to approximate like what the Parent Plus loan would be this current academic year at 908. So I just took a hypothetical 9%, and I calculated the payment based on both a 10 and 25-year, right, standard versus extended repayment schedules. And what do you get for numbers? Well, the 10-year payment is $1,267 and some change per month. The 25-year payment is $839 per month for a difference of $428 per month. Now, of course, people don't always think about 10 and 25 year. These differences can also apply to, let's say you're already on a 25 year, but you want to throw extra money at the principal every month, or whatever the case may be. I'm just using this as an example. And so, what does this look like? Okay, pretty simple. And you can see the chart there, right? The blue line is the 10-year payoff. The orange line is the 25-year payoff. And so there's no real surprises here. And if you then look at, okay, total amount of interest paid on the 10-year loan, you would pay $52,011 in total interest over the course of 10 years. And over the course of 25 years on that extended payment plan, you would pay $151,759, or almost triple what you would pay on the 10-year plan. So if you look at this alone and you think about the typical financial advice that you might hear from a Dave Ramsey, Susie Orman, or anybody like that, right? And I certainly see tons of articles, and my clients and prospects ask me about this all the time. If this is all that you knew, and this is all that you were concerned about, you would say to yourself, yeah, of course I should accelerate the payoff. I should pay off my loans in 10 years or throw extra money in it because I don't want to pay $151,000 in interest. And dear Lord, I don't want to keep the loan 25 years. That makes sense. But is that the best way? Maybe, maybe not. Let's take a look. Well, what if? Now, remember the difference in loan payments. What if instead instead of doing the 25-year loan, we did 10-year loan, we instead went to the 25-year extended payment. Or again, this similarly can apply to, if you had extra money every month you want to throw on the loan. But what if you took that extra and you saved that difference? So in our example here, it's $428 a month. Okay. So yeah, you can have the loan for 25 years, but you're going to save the $428 a month. And I ran this at a hypothetical 6%. Now, I just pulled that out of nowhere. I'm not saying, again, I'm not guaranteeing that you're going to earn 6% on your money or whatever. But here's an important point, right? Remember, I ran the loan interest rate at 9, and I'm running this at 6. And again, if you go back to traditional financial advice or how people shop for loans, right? What's the most important factor that people look at? The interest rate. Right? So you go out and get a car loan, you get a mortgage, you get a credit card, you get a student loan, whatever, right? What do you ask all the time? What's the rate? What's the rate? What's the rate? Okay. And so if you think about this example, right, what would be the traditional financial advice about this? Well, wait a second. If you took the 400, if you paid down the loan faster, you'd be saving 9%, right? Because the loan interest rate's at 9%. But if you saved it separately in an investment account and whatever account, you're only earning 6, you're behind by 3% a year. And of course, people have said to me, Jack, you're out of your mind. Like, why would you possibly want to do this? But as I think, this goes back ways and depending on how old you are, right? So if you watch ESPN college football, Coach Lee Corso always said, but wait, there's more. So if we do that, right, if in the 10-year version, we could pay off the loan in 10 years, right? So if we did this instead, when could we pay off the loan? Well, let's take a look. Actually, so you see the blue line, which is the loan going down, the orange line, which is the 25-year loan going down. But now there's that gray line, and you'll notice it crosses at one point, right? That's the gray line's the $428 being saved every month. That's 6%. So where does it actually cross the line? Because I know I don't have any numbers at the bottom, but you can see it's 25 years across the bottom because it's the 25-year loan on the orange line, but it actually crosses the 25-year line at 11 years. So hold on a second. Like, let's think about this. Like, what does this actually mean? Well, okay, yes, if you did the 10-year version, you would be paid off in 10 years. But if instead you extended out the loan and saved the difference, you would have enough money in 11 years to just write one big check and just pay off the loan anyway. So yeah, you wouldn't pay off the loan in 10 years, you paid off the loan at 11. Okay, not the end of the world, right? But think about what happens during those 11 years in this example, right? One of the things that people often, talk about in the media is, well, because my student loan payments are heavy, I can't build up an emergency fund, or I can't build up a down payment to buy a house, or I can't do this or whatever. And this goes back to that Shed report. It says, 37% of Americans can't afford a $400 extraordinary expense, or you need tires for your car, something breaks, whatever, right? But during this 11-year period, you would have the money to do that if you needed it, right? If you needed it. So you can do this. And by the way, this works with other types of debt. So I've had people ask me like, well, I have a 30-year mortgage. I want to throw an extra $200 a month at it. So reduce my 30-year mortgage down to 25 years. And I would show them the same example. Like, what if you took that extra payment, just saved it? And in a lot of cases, you would have enough money to just be able to pay off the mortgage in 25 years if that was sort of the example, right? So this concept is not unique to student loans. So but what people forget, okay, and this is the biggest thing, and as human beings, we are really bad at projecting, especially numbers like this. Okay, we might project in all sorts of other ways and in our personal life, but we're really bad at projecting numbers. What people forget is what happens after that 11-year mark. Now, in this graph, you see that gray line, we continue to save the $428 a month, but it continues to earn. And so if you ever, if you understand the principle of compound interest, right? After a while, interest earns interest. But if you ever look at a compound interest graph, the slope of the curve, if you will, right, gets increasingly vertical because compound interest accelerates. And so we don't often think about that because, we're so focused on get out of debt, get out of debt, get out of debt. Okay. So, yeah, in this case, you could pay off the loan 11 years. But what if you didn't? What if you just continue to save, let that savings grow and just continue to make your payments on the loan? Well, at the end of 25 years, you would have almost $300,000. Now, I know what you're thinking. It's 25 years out, blah. I actually had someone say that to me. Yeah, but it's 25 years out. And of course, my response to them was, well, 25 years from now, if I show up with a check of $300,000 for you to give to you, would you take it? Well, yeah, we'd all say yes to that. Right. And so we forget about sort of this compound interest effect and what happens after because we're so focused on just getting out of debt. And so the people really forget about this gap. Yeah. So 20, if you look at the graph, at 12 years, 15 years, 20 years, 23, 24, 25 years, there's still debt, but our money is continually growing, 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 growing. Right. And so you have the difference. And so financially, if you now think about how you don't have, the general or the average American doesn't have a lot of savings or whatever because they don't do this, right? They don't give their money time to grow. They don't let it compound, et cetera, et cetera. And so yes, you might have debt, a little bit of debt at the 24-year mark, but I guarantee you're going to have way more money in that investment or savings account, if you will. So that net, you're still way ahead. Right. So people kind of forget about this because they're so focused just on the paying off the debt. Now, actually, before I go back to that, let me go back to this. I had pointed out that the loans were at a 9% interest rate, and I ran this hypothetical at a 6% interest rate of our savings earning. And again, the normal traditional financial advice would be that is a terrible deal, right? I'm sure that many of you have heard, hey, any extra money you throw towards a loan, you're basically earning 9% because that was the interest rate on the loan. So why not earn 9 by putting extra money on the loan versus saving it here and only earning 6? And I understand that argument. But there is a fallacy to that argument. Okay. And here's what it is. Because at the end of the day, it is not about rate, it is about dollars. So think about our loan example, right? It's when you make payments on loan, right? At first, it's 9% on $100,000. Then it's 9% on 99,000, then 9% 98,000, and 9% 97,000, and on and on and on and on, right? Till you get down to the end where it's 9% on the last $100 of the loan balance. Okay. But your money is growing in this hypothetical example. So yeah, it's only 6%, but initially it's 6% on $428. So then 6% on 1,000, then 6% on 2,000, then 6% on 3,000, and on and on and on. So when you do this basic third grade math, at 25 years out, right? If you think about this, at 25 years out, that that where the account balance is now almost 300,000, 6% of 300,000, I guarantee you is more than 9% of the last $100 of the loan. Think about it, right? As you give it more time, it's 6% of a bigger number is always more dollars of earnings than 9% of the small loan balance that's left. And that's what accelerates wealth building and the interest compounding. Okay. So what actually matters, right? Because again, we're so focused on interest rate, interest rate, interest rate. What actually matters is actually not interest rate. And you can use any financial calculator out there on the internet and you can change these numbers around. And obviously, it would change some of the time around, so instead of earning 6, you can run at 5 or run at 7 or whatever. But what actually matters towards building wealth? It's time and dollars. The interest rates, yes, matter, but not as much as people think. And so this hypothetical example really illustrates that. The more time you give money to grow, the better off you're going to be. The more dollars you put towards it, the better off you're going to be. Okay, yeah, that makes sense, right? So the actual interest, so whether you earn 6 versus 7 or 5 versus 6, or the loan interest rates really 8.5 versus 9 or 9 versus 9.5, yes, they do matter, but not that much. It really is not that much. So what does this mean at the end of the day, right? We know American finances are tight because of debt, because of inflation, because of everything else. But the fixation on paying off debt might not be the best thing. Yes, a lot of times people will say, if I have the debt paid off, I will sleep better at night. I completely understand that, right? But that is an emotional response, but I get it, right? But if you actually look at the numbers, and if your goal is to build wealth long term so that you have more money in retirement or more money to buy that vacation house or more money, whatever, then you need to really save and deprioritize paying off debt. That's assuming also that none of you get the $1 million bonus from your institutions, which I know happens often, but that's a different story, right? So paying off debt faster is not always the better financial decision. It's giving your money time to grow and getting more dollars to grow. Right. Now, again, I understand how that can be controversial. It's opposite a lot of the advice. So for what you have to decide as individuals is you have to decide what your balance is and where you're comfortable. But don't necessarily just take that pay off debt, pay off debt, pay off debt advice as being the best thing for you because oftentimes it actually is not. There is my information there. Always happy to answer questions. So Patrick, I know that was quick. I think I'm basically out of time anyway. What questions, if any, do we have?
So there aren't any questions in the chat just yet, Jack, but that was fantastic. And I'll tell you, the numbers you gave, just to put a finer point on this, you talked about someone having almost 200 or over $296,000 in 25 years of saving about $400 a month, which is fantastic. If you started saving at age 21, if we were giving college graduates this advice and they start doing just what Jack told them at age 21, yes, they're going to pay off that debt a little bit longer and you have to offset the interest that they're paying there. But to Jack's point, by 46 years old, by the way, 6% is anywhere from 1 to 2% less than most advisors use in terms of estimating your return on investment. Jack was being conservative for good reason. If you were at 7.5%, you'd have over $350,000 by the age of 46. And remember what I said at the beginning, by 55 right now, the typical Gen X household has 40,000, and one study shows a median of less than 48. You could be over $300,000 better 10 years younger. So it's just something to consider. And as Jack pointed out, as he always does, this is just a high level example. There are always a lot of other variables that fit into someone's specific financial picture, but that's why I always encourage you to reach out to your financial advisor. And if you don't have one, feel free to reach out to Jack. If there are no questions actually and aren't in the chat yet, I will leave this here for now, but feel free to think of those questions, put them in the chat, come back here, come off mute after Suzanne's session. We'll try and give ourselves a few minutes to answer those questions that you may have. So having said that, let me pull up Suzanne's bio here. I've known Suzanne and crossed paths with her for many, many years, but this is our first opportunity to work on a presentation together. So I'm very, very happy to have her. She worked for a state guarantee agency back in the FELP days, pre-direct lending, was a financial aid officer at a small business school, and then worked at the University of Connecticut in the Office of Financial Aid Services for 26 plus years. And she currently works for RISLA, a quasi-state private education loan provider in the Division of Employer Student Loan Repayment, which is a benefit currently offered through the CARES Act that states employers can assist employees in repaying their student loans. It's a tax-free benefit for the employee, and that can be up to $5,250 per year. And actually, correct me if I'm wrong, Suzanne, but I believe an employer can do more, but only the
Yes.
first $5,250 is tax-free. So it really is a wonderful benefit, just one of the things that Suzanne will be talking to us about today. So Suzanne, thank you so much for joining, and I believe you can now share your screen as well.
Okay, great. Thanks, Patrick. I want to thank you and MASFA for asking me to do this today so I can share what I know. It's always, and I'd also like to say hello to all my financial aid advisors out there. And thank you for all that you do every day because I know you have the tough job. I used to do it. So, all right. So as we take our students from borrowers to graduates in repayment who become employees, I want to share with you some financial wellness benefits and strategies that could be beneficial to your student borrowers when they leave your institutions and enter the workforce. So, federal and private student loan debt is real. The average student loan debt is hovering at about $38,000 per borrower, with an average monthly payment of between $400 and $500 a month. It's pretty big and is impactful. When your students enter repayment and also the workforce, there are what I consider two types of employers. There's a non-public student loan forgiveness employer and a public student loan forgiveness employer, or PSLF. If borrowers do not choose a payment plan, I'm sure you're well aware that when they enter repayment, they are automatically enrolled in the standard repayment plan. This is a payment plan where they make 120 of the same payment pretty much for those 10 years. And for those borrowers that need to extend the life of the loan or start payments out smaller and have them increase over time, then there are the extended and graduated repayment plans. Keep in mind that payments made in the extended and graduated repayment plans are not qualifying payments towards the PSLF count of 120. Therefore, if a borrower is working for a PSLF eligible employer and is enrolled in either one of those payment plans, the graduated or the extended, the payments will not count. If the student loan borrower works for a PSLF employer, they should be in one of the income-driven repayment plans or the standard repayment plan. All right, so just something to keep in mind, because I'm hopeful that you help them help to explain all the different repayment plans out there. There is a tool on studentaid.gov called the Student Loan Simulator. And this tool allows borrowers to choose a repayment plan that is right for them. By reviewing different repayment plans, it helps compare monthly payment amounts, and it also will take a look at the total amount of that they'll pay overall. And again, that website, if you haven't heard of it, it's studentaid.gov/loan-simulator. I'm sure you've all heard of studentaid.gov, but maybe not the loan simulator. Something else borrowers should consider if they should refinance their student loan portfolio. And Patrick, feel free to jump in. I know this is an area for you, so if I miss something that you think I should say, please pipe in. So if student loan borrowers have variable interest rate private education loans, they should definitely investigate refinancing those loans with a company that will offer a lower fixed interest rate. And really the key word there is fixed rather than variable. It will also combine their loans to one loan and one payment, which is a great thing. There's also employers out there that have partnerships with private education loan lenders that will also offer additional interest rate reductions. So when your student loan borrowers become employees and they're comparing job offers, they should be looking at the additional benefits that the employer is offering. And one is interest rate reductions if they are looking to refinance. So I work with employers. I work with HR directors now. And well, with working with employers, the big buzzword is wellness. Employers are finding employees are so stressed out, which interferes with productivity. So to help offer a solution, employers are offering financial wellness benefits in the workplace to help. And it helps them with attracting, retaining, rewarding, and offering relief to their employees. With one study stating 78% of employers or employees experience financial stress, that's a big number. So this is why there's a really big focus right now on wellness, not only health wellness, mental wellness, but also financial wellness. And financial wellness benefits in the workplace include budgeting tools, financial literacy libraries, student loan repayment benefits, tuition assistance and tuition reimbursement, 529 plans, as well as retirement plans and resources. When your student loan borrowers are comparing job offers, again, they should be reviewing what benefits each employer offers beyond health and retirement benefits. One benefit that has been growing in popularity that I want to share with you is the student loan assistance programs. And this is an area that I now work in and administer for companies throughout the country. All right, so if you look, there is also an increase, not a big increase, but employers are definitely starting to look at student loan benefits to help their employees. A really big one, again, there's a few that I'm going to mention, or a couple that I'm going to mention, but the first one is the Employer Student Loan Repayment Program. And what is the Employer Student Loan Repayment Program? Well, it's currently a benefit through the CARES Act. Although there is a bill with bipartisan support to remove it from the CARES Act and make it a permanent self-standing bill and benefit. So here's hoping for our future. This benefit allows employers to contribute to their employees' eligible education student loans up to $5,250 a year, and that amount is tax-free. What I do want you to keep in mind is that this benefit is in conjunction with tuition assistance or tuition reimbursement. So if an employer offers the employer repay benefit and the tuition assistance or tuition reimbursement program, the maximum tax-free benefit of the $5,250 is in combination of both of those benefits. All right. The employer student loan repayment benefit is a fully customizable benefit, so employers can determine who receives the benefit, how often they receive it, and also an amount. I work with employers that some employers offer it to their employees right when they start. Some and most employers offer this benefit to their employees after they've been there for 90 days. I'm currently working with an employer in California that is going to be offering it to their employees after they've been there for 3 years. So again, it's fully customizable. Employers can determine who receives it, when they receive it. I have some employers that offer it monthly. I have PSLF eligible employers that offer this benefit. And what they do is they want the payment that they are making on behalf of their employer, of their employee. The PSLF folks, they want the payment to go towards their employee's monthly payment. Non-PSLF eligible employers like to utilize this benefit, so they ask that their employee makes their monthly payment every month, and then they make an additional payment, which cuts down on the life of the loan and the amount of interest that would accumulate. I did previously mention eligible education student loan, so I just want to give you a definition of that. So the recipient of the benefit must be the borrower. And also the employee must have attended a Title IV institution, and the education loan must have been used to directly pay for the employee's education. That means that no PLUS loans are eligible to receive this benefit. If you took out like a home equity or a line of credit or made credit card payments towards your fee bill, those payments or those loans will not qualify for this benefit. And payments are basically sent on behalf of the employer directly to the servicing company of the employee. And that's how the payments are made. And again, it's a tax-free benefit. There's another student loan benefit in something called Secure 2.0. And it's a bill that allows employers to match the amount an employee contributes to their student loans in a retirement account. This benefit aims to assist in offering immediate financial relief and supporting long-term retirement goals. So those are the two big student loan benefits out there, the employer student loan repayment benefit, and also through Secure 2.0, there is a matched student loan payment, or up to whatever the employer decides. So I also put this out in the presentation because this is a great handout to create for your students to let them know that the employer repay benefit is out there for them. I have had many employees contact me and then in contact their HR department, and the HR department, through conversations with myself and my team, are now offering the employer repay benefit to help their employees. So I find this is a great way for new employees to advocate for themselves. And lastly, this is my contact information. If you'd like to have a conversation regarding anything that I discussed. I also want to thank MASFA and Patrick again for asking me to come on. I wish you a great day, and I also want to thank you for making a difference in your student lives.
Great job, Suzanne. Thank you. And let me
Thanks.
just point out too, and feel free to add any additional context here, but you talk about these employer benefits. Let's keep in mind, and I'm sure this goes without saying, but just to put a fine point on this, colleges are employers. So this is a benefit that even our financial aid friends could be talking to their HR offices about,
Sure.
because especially in higher education nowadays, at least in the SUNY system, it was not too long ago. Maybe this will change as the demographics up here change. Maybe it's getting a little harder to fill some of these director level positions. But I know when I was working for SUNY, you had to have a master's degree to apply for a director level position. So especially in higher education, we're encouraging education. We require education. We now require more graduate education for people to get promotions. This could be a great benefit for people to talk to their HR offices about.
Yeah, Patrick, I find the medical profession, the medical area is really utilizing this profession, this benefit right now. I work with hospitals, they're having trouble retaining night nurses. So since it is fully customizable, they're offering it to their night nurses. And as they retain that group, then they look for other groups within the hospital setting because there's a nursing shortage right now. So I have, and again, it's fully customizable. I have companies that have a tier system. So first year they're offering it. First year you've been here, we're going to offer you $100. Second year, we're going to increase it to $200. That's a great way to retain them. And I've had many medical professionals contact me stating that, whatever the company they work for has helped them, and their loans have now been paid off. So it's a huge burden off of their backs.
Yeah, it's a great point. It's a fantastic recruitment and retention tool to offer this type of a program. And you point out the customizability. There are companies that are saying, "Look, we'll match, or we will do an additional payment on top of what you pay." There are other companies. I work for one that was just making my entire payment for me, and those payments counted towards PSLF. Unless they change the regulations, with PSLF, the important thing is that a payment is being made and that you are on a qualifying program. There's nothing in the regs that say it had to come from your checkbook and not
That's
your
correct.
employer's account.
Yeah, and we all know that people in the SAVE program were currently just put in a forbearance. And if they're PSLF eligible employers and their employees are in this forbearance, there's going to be a buyback program. I've actually had quite a few employees contact me about the buyback, and they're utilizing their employer money to buy back the payments that were in forbearance and then get to that 120. So again, the 5250 limit is the tax-free. I also work with companies that offer $10,000 a year to their employers and to their employees, and they're just then they have to include the extra money over the 5250 on the W-2 form. But otherwise too, this benefit does not have to show up on anyone's W-2 form. You know, there are certain IRS rules that have to be met. But again, like when you hire a company like RISLA to administer it, then RISLA does the verification process as well to keep it IRS compliant. So it's a fabulous benefit, and not many student borrowers know about it. So that's why I'm so happy that you allowed me to be here today.
Yeah, it is a fantastic benefit, and I'm actually surprised. Now, I know that a lot of this was due to COVID, but
Mhm.
just in full disclosure, I also worked in this space briefly. That's how Suzanne and I really got to know each other. And you know, we talked about this before, that SHRM was predicted, the Society for Human Resource Management. I apologize for the acronym, but SHRM was actually projecting this benefit to absolutely explode just before COVID,
Mm.
and then COVID hit, and obviously that kind of slowed the
Yeah.
growth. But from everything
Mhm.
I've seen, it's now on a growth curve again. And it should be. Listen, if we're going to talk about a student loan debt crisis, and again, some
Mhm.
economists would disagree with that phrasing, but there certainly are demographics of borrowers who are truly struggling. And when you look at some of the issues you have in hiring certain professions like healthcare, why would you not offer this benefit? It's proven to
Yeah.
help recruit and retain employees.
Exactly. Yep, it definitely is. And it's impactful. Um, you know, I get goosebumps sometimes when I talk to people that are receiving it and hear what a difference it's making just in their day-to-day lives. So, yeah. Mhm.
Right. Right. And so I'll wrap this up unless we have any questions. And feel free to come off mute, by the way. We didn't structure this as, I don't know if you do it as a certain type of webinar. People can't turn their mics on or their cameras on, but you can certainly do that here. So we set it up that way specifically. But I'll come back to what we talked about in the beginning, is that really when we talk about not just us as employees, and many of us have questions about how we're ever going to get to retirement. I know I do. We're also advising young people about how they can manage student loan repayment, go out and try and find their way in the world professionally, career wise, but then also start saving up for certain financial milestones. And Jack and Suzanne and I have talked about this data. There's a wealth of research out there to talk about how student loan debt is negatively impacting people's ability to start a family, to buy a home, to save for
Mhm.
retirement, to create an emergency savings account. So again, I come back to the same point I raised at the beginning of this session. So thank you so much, Suzanne and Jack, for joining us. Which is that we may or may not really have a student loan crisis. Although I know, and again, to be very clear, I know repaying student loan debt is an absolute crisis for many people. I get it. But writ
Mhm.
large, if you look at this statistically across the country, and we have what, over 4 million, I believe it is now, over 40 million, I should say,
Mhm.
education debt holders. Even if we don't have a student loan debt crisis, we have financial crises brewing, and student loan debt is a part of it. So the more information that we can share, not only with you, but then we can share with students and these early career employees to help them manage the debt, the better they can do at saving to start a family, having children, buying a home, saving for retirement, you know, eventually, hopefully retiring at some point. Some of us used to kid during the Great Recession that we were going to die at a booth at a conference somewhere. There could be worse ways, to be sure, than being with all of you. But again,
Mhm.
fantastic advice from Suzanne and from Jack. Anybody want to come off mute, turn their camera on if you like, ask any questions while we have these two professionals here. Otherwise, make sure you took their contact information down so that you can reach out to them at a later date. But any questions before we wrap up here for the day?
Patrick, I think we did an excellent job giving them all this great information.
You must have, because there are no questions, but I'm getting some thank yous coming in. So, hey, let me do
Yeah.
one more thing then, folks, if you don't mind, as we have a couple of minutes. I put a link out there just as a reminder. The financial wellness education does allow people to pick up a financial wellness education certificate at the end of the year.
Mhm.
We do a pretty nice job of it. We put it in a nice little folder, put a gold sticker on it, so you can put it on your desk, put it up on the wall, add it to your curriculum vitae, and really show people in this space, as you look to build and develop your career, that you really are trying to develop your subject matter expertise and really gain the knowledge that you need to be able to serve your students and borrowers even better. So feel free to check that link. Any questions, feel free to reach out to me or any member of the financial wellness team. And with that, I will put out one more call for questions. And if we hear none, I know I am going out to enjoy this beautiful day, and I hope you can all do the same. Again, Jillian, team at MASFA, thanks so much for your help as
Mhm.
always.
Thank
Suzanne,
you.
Jack, phenomenal
Yeah,
information.
thank
Great
you,
to see you
everyone.
both. Thank you all for joining, and have a great day.
Thank you so much. That was great.
Thanks, Jillian.
Thanks, Jillian.
Yeah, you two did a phenomenal job. That was even better than I could have hoped for in terms of the